Hello, everybody. Thank you for joining us for this latest episode of Coffee with Bob. Coffee with Bob is a mini webinar series brought to you every other Wednesday where we cover timely topics. And today, our investment committee is back, well, at least some of our investment committee here at H&A for another episode, Bernie Carter and Bobby Apanowitz. So Bernie is a CFA and a CFP. He is our managing director of investments here at H&A. Bobby is a wealth advisor, and he also helps head up our investment committee. And we're really excited to bring this topic to you guys today. Active funds versus passive funds. It's one of the most popular questions that is asked amongst the investment world. What is better, actively investing or passively investing? Actively managed funds or passively managed funds? Well, that answer may differ from one advisor to another or one advisory team to another, but what we're going to do today is in this episode, explain what active funds and passive funds are, talk about their pros and cons, and then we're going to bring it all together and share with you guys how we like to use active and passive funds together in conjunction with one another to get the most out of your portfolio. So let's jump right into it. So let's talk about active and passive funds. Let's define them. Bernie, why don't you talk about active funds for us?
Sure. Thank you, Chris, and thank you everyone for being with us today. So as we jump into it, one of the first things to think about is when we invest our money, we have a lot of choices available to us, many choices. And, you know, that fact is both liberating to have so much flexibility, and at the same time, it can be confusing and can lead to indecision. So just something to be mindful of. And one of the biggest decisions that you can make when you invest your money is deciding between active and passive fund management. And when you invest in an active fund, you are investing in a fund that employs a portfolio manager and usually a team of research analysts, and they conduct intensive, in-depth, deep dive research into companies, into industries, into sectors, and they pick stocks and insert them in the portfolio that they think are going to outperform their competitors and outperform the market in general. So that's the intention behind all of this work, all of this research, is to put together a portfolio that will beat the market. It's very work intensive. It's usually more expensive than passive investing, but the intent is to outperform the market or a benchmark.
And active investing and actively managed funds, it seems like they go in and out of favor over time. Would you say so?
Yes, good point. They do come in and out of favor, and that's often in connection with how well they're performing on a relative basis. And the thing about active funds is they tend to outperform in difficult markets, choppy markets or down markets. The flexibility that active fund managers have enables them to avoid companies or areas of the market that are destined for trouble. So generally you get, a bit more downside protection, better performance during those times. And that, not surprisingly, is the time when they tend to be in favor. Tend to be a little more out of favor during momentum markets where the markets are moving strongly in an upward direction. And they will at times or often, lag passive counterparts. And that's the time that they would be out of favor.
All right. Okay, thanks, Bernie. So let's move on to passive funds. Bobby, define passive funds for us and talk about their main characteristics.
Absolutely, Chris. Yeah, passive funds work a little bit differently than actively managed funds do. Whereas an active manager is, of course, actively trying to beat the market, a passive fund is merely trying to mirror market performance. And the market that it could be tracking could be an index like the S&P 500. It could be an asset class like large companies or small companies, or it could be a geography like the United States, Europe, Asia, or whatnot. And it tracks that market benchmark or index by simply owning the same individual holdings or companies that underlying index would. in the same proportions of that index would. And doing so does a couple of things. One, it takes the emotion out of investing, at least at the fund level. And number two, it drastically reduces costs in most cases because, again, as Bernie alluded to, active managing is very labor intensive. There's a lot of analysis that goes into it. Passive funds tend to require less work to maintain the investment process, and therefore they cost less. So again, to summarize, passive funds tend to work best for folks who are long-term investors and understand that market performance will be best for them over the long run.
And it seems like there's just been this huge growth in popularity amongst not just, advisors, but individual investors as well. This huge growth in popularity in passive funds and in passive investing, especially over the last 5 years or so, wouldn't you say?
Yeah, that's absolutely right, Chris. Actually, last year, middle of last year, there was a big landmark in investing in which the amount of assets in passive funds for the first time ever was greater than the amount of assets in actively managed funds. And
wow,
that really is historic. It is a landmark, and it signals a change in how investors view investing.
Absolutely. All right. Thank you guys for that. So let's move on to the next part of this episode. Let's talk about the pros and cons of each, which in our opinion, help form the decision about if and how to use active and passive funds within a portfolio. So let's talk about active funds first. Bertie, there are a bunch of pros and cons here on this screen. Which ones, stand out to you the most? Which ones are the most significant to you?
Sure, Chris. So with active funds, I mean, there's several pros, but the one that stands out, I think, is the fact that a lot of work is done there with the intent of outperforming the market, intent of doing better than the market. And that really dovetails well with who all of us are. I mean, we all endeavor to work hard and to do well at our jobs and to do well as parents and as spouses, et cetera. So it's natural to want a fund, to want your investments to perform better. And that is the intent behind active. And I think that's probably the biggest positive. On the con side, just have to keep in mind that all of the work and the personnel that are required to put together a team that can outperform the market and do all the research, it's expensive, costs a lot of money. So active funds tend to have expense ratios that are higher than passive funds, and this higher. I mean, keep in mind that higher expenses equals a bigger bogey against your earnings. So active funds have a bit of a higher hurdle to clear to getting to that outperformance because of the expense.
Yeah, and it's so interesting because when you look at the data, most active managers aren't able to outperform their benchmarks like the goal is. Most of them actually underperform their benchmarks. So, that leads to probably one of the biggest questions that are asked when making the decision to use an active fund is, when is it worth that extra expense?
Good point.
Yeah.
Point.
All right. So let's move on to passive funds. Bobby, let's do the same thing. Pick out a pro and a con for me, pick out pros and cons that are most significant to you.
Sure. We touched on this a little bit on the last passive fund slide, but again, the two biggest bullet points that stick out to me are the ultra low fees and tax efficiency that are associated with passive funds. Two of the most important components for investors, especially long-term investors, are making sure that fees are in check and that your tax situation is as efficient as possible. If those two are not in check, that can really eat away at returns, especially over the long run. And passive funds, because of their structure and because of their investment process, again, are very low in fees. There's not much analysis going on day in, day out. Because of that, there's also less human error that is involved with that process. And because there's very little trading in the funds from day to day, the only time there is trading is when a fund is added or removed from the underlying index. Because there's very little trading, they're more tax efficient than active funds are. And that, again, is a huge positive for passive funds. And with this investment style, there is the inherent con that you will never, of course, outperform the market. You will mirror the market, probably get market performance less a couple of basis points for fees. And that's what you can expect to get year in and year out.
Which isn't necessarily a bad thing.
Absolutely, Chris. And to your point on the last slide, many active managers that are trying to outperform the market, many of them aren't successful in doing that, especially as the time periods get longer and longer. So again, the longer you are invested for, the more favorable those market returns turn out to be.
All right, thanks, Bobby. So let's move on to the last part of this episode. Let's put it all together. Let's talk about when active funds could best be used in a portfolio versus active funds, passive versus active funds. And, like I said at the beginning of this episode, it's going to look different from one advisor to another, from one advisory team to another. But to provide context, what we're going to do is talk about how we here at H&A believe passive funds and active funds should be used in which sectors of the market. And it's based off of our guiding investment philosophy, which you can see here on the screen. It's that the markets are largely, but not entirely efficient. So keeping this in mind, Bernie, why don't I turn it over to you and let's talk about where we like to use passive and active funds within the portfolios that we build.
Sure. So, as we mentioned a few moments ago, there were just so many choices available to us as investors, and the choice between passive and active stands at the top of the list as one of the more important decisions we need to make. And at H&A, we have made the decision to use both where appropriate. The history has proven that in certain areas, passive funds have outperformed, and in other areas, great research will deliver outperformance. So keeping that in mind, we have decided to, on the passive side, allocate assets to those areas where the market is very efficient, where there's a lot of analyst coverage. There's a lot of research, a lot of resources poured into discovering the events that drive the fortunes of companies. So prices tend to track intrinsic value very closely. And examples of these areas are U.S. large caps and U.S. mid caps. And here we're looking for allocation precision. We're looking for very low cost and tax efficiency to give us exposure to those areas where passive makes sense. Conversely, there are areas of the market that it's just harder to uncover information for analysts. Some areas have fewer analyst coverage. Some areas, because of their geography or their political environment, it's just harder to get information. So examples of these would be U.S. small companies, international, and certain areas of bonds of fixed income, such as corporate bonds. Here, historical data has shown us that great managers with great research teams can uncover diamonds in the rough and deliver superior long-term outperformance, and we have made the decision to allocate to these funds in these areas.
Yeah, so that being said, though, these areas for active funds, they can change over time. Wouldn't you say so, Bobby? Is that right?
That's exactly right. Especially, throughout the course of the business cycle, it can be very important to keep track of where you are in the business cycle, and that can impact which investment style is more in favor at that time. As Bernie mentioned earlier, in choppy markets like those we typically see at the later stages of the business cycle, where business conditions are tougher and only the strongest and healthiest companies are equipped to survive and thrive in that environment, it can be helpful to have the flexibility that an active manager does in order to avoid certain companies or areas of the market that aren't as well equipped to handle those periods.
Mm-hmm.
On the flip side, in the early stages of the market, of the business cycle, tend to be momentum-driven markets in which, because business conditions are favorable, all companies are able to thrive and prosper, at least most companies, the market as a whole. And in those cases, it makes a lot of sense to drive for efficiency in both expense ratios and fees, as well as taxes. So those are the things that we look at H&A to look at whether or not it's favorable to have an active or a passive fund in any given asset class.
All right. Awesome. Okay. Thank you guys. So that's it for the episode. We're going to jump into some questions. We have a few here submitted, so let's bring them up. All right. Number one, does using passive investments mean you're doing less work compared to using active funds? Great question. Bernie, how about you take that one?
Sure. Yeah, that is a great question. And I think, yeah, it is tempting to think of it that way. But keep in mind that even if you make the decision to allocate to passive style of investing, the allocation decisions within that still need to be made. You should decide how much you're going to put in large caps, mid caps, international, et cetera. You're still going to need to decide how much fixed income you need in your portfolio to dovetail well with your financial plan. If you're tactical at all, you're going to need to decide when to add to stocks during downturns and excuse me, when to trim from stocks during times when the market rises. So all of this work needs to be done. And with passive managers, none of it is being done at the security level. So it needs to be done at the portfolio level. And that's what we do at H&A. And so therefore, we think the inclusion of passive actually results in a little more work for us. It's work that we're happy to do for you, but it is more work, and we think it leads to added value and higher returns.
Yeah, absolutely. I mean, you know, that's a good thing, because when people hire us, they hire us to manage their money. And so the implementation of passively managed funds gives us more transparency within the portfolio and therefore more control to, you know, carry out that very disciplined rebalance strategy or make those occasional strategic or tactical moves within a portfolio and, you know that it's being done in the right way, in the way that we want it to be done, keeping in mind the investment game plan that has been laid out. So it's a great question. Okay, next question. If you are a firm that uses a lot of passive funds, and one of the cons on the screen was that there is limited or no opportunity to beat the markets, then how do you at H&A try to beat benchmark returns in your portfolios? Another great question. Bobby, why don't you take that?
Sure, that is a great question. And I'd like to start by saying that we at H&A call ourselves asset allocators, meaning that we believe that the vast majority of outperformance can be attributed to choosing the right balance between stocks and bonds and choosing the right sub-asset classes of stocks and bonds within a portfolio rather than individual stock selection. So we're asset allocators. And we attempt to drive that outperformance through a couple of different measures. One is rebalancing, and two is tactical adjustments to portfolios as we see fit. And there are several measures that we use. There are many different measures that we use to tell us whether or not it's time for a rebalance or time for a tactical adjustment. And in the interest of time, I'll go over the two most important ones to us, or two of the biggest ones to us. The first of those being your current allocations versus the target allocations that you have based off of your long-term goals and needs. And the second being valuations of the market. And I'll give an example, a couple of examples of moves that we've done in the past couple of months. to a year to help explain those a little bit more. Back in December of 2019, after the S&P 500 was up 30+%, the the amount of stocks that were in portfolios appreciated in value to the point where your stock allocations in many of our clients' accounts were above their targets. So we looked at that as a good time to trim back from stocks to their targets and add to bonds or to cash buckets, especially for clients who are relying on their accounts for retirement income. So that's one example of a rebalance that we would do. Another example is this past March when broader market indexes were down 30+%. That caused stock allocations and accounts to fall below their targets. And that was a good time to take from dry powder in the form of bonds and cash and add that to stocks. And by doing so, by making these types of tactical rebalances and tactical adjustments, we really do believe we can drive out performance and should drive out performance over the course of the business cycle.
All right. Another great question. Okay. It looks like we have one more question here. What is the difference between ETFs, so that's exchange traded funds, and mutual funds? Bernie, you want to take that?
Sure. So they both offer, the biggest feature that they share is they both offer instant diversification. For a reasonable amount of money, when you buy a mutual fund and an ETF, you can get exposure to dozens or even hundreds of companies. And that's the biggest positive for each one. That's why they came into existence, to provide that diversification. And mutual funds is more the historical structure, the one probably most of us are most familiar with. It's been around for decades. It's very user friendly, and it offers end of the day pricing, meaning if you put money into a mutual fund today, say at 11 a.m., the portfolio will be priced at the end of the day, and you'll get the price that results from the market close at 4 o'clock. Couple of evolutions have occurred with exchange traded funds. One of them is kind of apparent in their name, exchange traded. Now, ETFs are traded on an exchange throughout the day. So if you buy it at 1 p.m., you get the price at 1 p.m. Now, some find that complicated and confusing. We love that feature here at H&A because it gives us precision. Bobby mentioned some of the allocation decisions that we were making earlier this year. Markets were moving very quickly. Assets were moving in huge percentage increments throughout the day. If we made a decision to buy stocks at 1 p.m. on a particular day because they were down 6%, then we wanted to get those prices, not the end of the day prices. So during those days, we were definitely using ETFs. Another evolution that ETFs have brought is tax efficiency. The exact way that works is beyond the scope of this discussion, but just suffice it to say that ETFs are very, very tax efficient. Stock ETFs do not distribute out cap gains to their shareholders, and this is a positive. This is a feature that we definitely take advantage of in our portfolios.
All right. Okay. Another great question. It looks like that is it for questions today. But if you do have any other questions, if you think of any others, please do email us. Our emails are at the bottom of the screen. You can always call us at 412-261-5966. And we really appreciate everybody tuning in today. And we'll see you in a couple weeks for the next episode. Thanks, everybody.
Thank you.
Thank you.